Welcome to the January Investor Advisory Review. We're doing this review from the Villa de Reynolds tonight. Working from home today just because I've had some illness over the last week. I'm doing fine, getting much better, and I'm definitely on the mend, but it just seemed much easier to do it from the home today. So I know the background looks a little different than normal, but here we are. So I hope you've had a wonderful holiday. I know that we last did this review in November. We took off December because of a lot of people with holidays and travel and so on. So we decided to restart in January. As I expressed last week, and thank you so much for those of you who were understanding. Well, you all were understanding, to be honest, about the fact I was not doing well last week. I was sick, but I'm definitely doing better now. And so thank you for those of you who've joined us tonight for this catch up to what I was going to do last week for the January Advisor Review. As always, want to take time, and especially tonight, to remind you of the disclosures for all investment options or considerations that we discuss, because there is no one size fits all. You need to consider that whenever we take a look at any particular investment program, whether that fits your needs, your wants, your desires, especially when it comes to things like growth and risk tolerance, income, flexibility, liquidity, and even tax issues as they may relate to your current situation. So these disclosures are here as just a reminder to everybody who watches this, whether it's on tonight or it's people in the future who see it on our website, that they understand that there is not a one size fits all. So please examine carefully whatever you decide to do when it comes to making these important investment decisions for your family's financial and wealth management goals and desires. We will have a time for questions at the end. You can either raise your hand or just type your question in the chat box. I'll be happy to take time to go through that with you. Tonight, we're going to talk about the 2025 investment economic outlook, likelihood of a U.S. recession, potential investment opportunities, the market tactical analysis that we're currently doing, some of the differences of Frank Reynolds and Company when it comes to portfolio management, as well as financial planning strategies, answer your questions, and just refresh you on the next review that's coming up. As you've seen me in the past when I've shown this slide, you may notice that the economic weaknesses, the red arrow, is smaller than in the past because it feels like there has been some change in data reporting and people's perception of that data. As you may remember from our previous advisory review, it was done after the election in which Donald J. Trump won the election both with the Electoral College and the popular vote, plus took all 7 of the swing states. Definitely has been seen by many as a mandate, and so things moved forward quickly after that. We've seen a lot of changes since that time, and as of just yesterday, there was the inauguration where Donald J. Trump is now the acting president of the United States as the 47th president. And there have been a number of things that are changing right now. Tonight, this has nothing to do with politics. It has everything to do with, as we look at data, we try to measure up what's going on to what we think is going to happen, and then try to make decisions going forward with that. So at this point, it seems to me there's much more economic strength to the U.S. economy, and that bodes well for the Main Street, for Wall Street, and hopefully even for yours and my street, as we take a look at how things are moving forward and how everything's working. A couple of pieces that I want to take a moment to share with you is one, the year ahead expected inflation. You'll see that it continues to move down, and I believe that it probably will continue to do so. I know that in the media, there's a lot of discussions about the fact that with the tariffs and the potential talk of tariffs, that could raise prices. But I think realistically, if we consider what 2016 looked like, it more than likely is conversation that causes the other participants to change their thinking and to be willing to adjust their tariffs with us so that we can have a more equitable playing field when it comes to the economics, both in our country and worldwide. And I have no reason to think this is any different, just from listening to even certain conversations, both politically and economically over the last few weeks. It seems very clear that the tariff discussion is not one that he's wanting to go out and raise tariffs. I believe he's fully willing to do it, but it's a conversation to get everything started so that our economic partners will maybe rethink some of their strategies. So with that in mind, I think the expectation of inflation is about where it's supposed to be, and maybe we'll even go a little bit lower, but it might not. It's going to depend upon how the Fed reacts to certain things, the growth in the economy, and so on. Those pieces can change this discussion, but I don't perceive that it's going to be worse. When we look at the S&P 500, the forward-looking price to earnings ratio, what we see is we see a continued climb. And we see that where it looks like it is a great opportunity for the stock market to continue on. And I'm going to share a video with you here in a moment with one of the, well, actually, it's going to be Bravos Research here, who we have been using some of their data over the last year and a half, and how it looks like whatever potential recession we were concerned about definitely may be pushed back. If you remember from many of our conversations throughout the last 20 months, we've been talking about the likelihood of a recession. It has seemed to get less and less over time, but I think now, because of a number of economic and even political factors, it seems like that is probably getting pushed out even further now, which bodes well for growth and opportunity in the investment markets and the economy in general. When we look at the Fed funds rate, we can see where it is today compared to where it has been in the past, and it's not overly high. It, as a matter of fact, has come down. I believe there were 3 rate decreases. Again, in an effort not to speed up the economy, I think that the Fed is going to be cautious. They talked about maybe having one more rate decrease this year, which would again continue to bode well, making money cheaper and easier to access. And so with those pieces in mind, it looks to us like we have an opportunity to see more growth. The National Bureau of Economic Research, which identifies recessions, typically identifies them looking backwards, not forward, even though I think everybody tries to do such a thing. We saw the small recession in 2020. Obviously, there was the Great Recession in 2007, 2008, 2009. But again, the issues don't look like that's what's boding for us here in the next 12 to 18, maybe even 24 months. So with that in mind, let me share with you a video that I think probably helps to explain this. I've never done this before, where I chose to share a video from one of our resource partners, but I decided tonight this might make a lot of sense, because I felt like while I normally pull data together and share information with you, my perspective, I decided tonight to take the video that Bravos Research put out on January 17th, which I felt like encompassed a great deal of what I was thinking as well. And I thought that with their charts and graphs, it might be good for you to see how some of the data we pull together looks and where it comes from. So let me go ahead and play this.
It's now been 17 months since the Federal Reserve's last interest rate hike to 5.25%. The reason 17 months is an important number is because that's the exact amount of time between the Federal Reserve's last rate hike in July of 2006 and the onset of the Great Financial Crisis. Back then, the Federal Reserve raised its interest rate quite violently to 5.25%, and 17 months later, the 2008 financial crisis began. Over the last few years, although the Federal Reserve also raised interest rates violently to around the same levels to 5.25%. Here we are 17 months later, and there's still no signs of the U.S. economy heading into a downturn. The U.S. unemployment rate sits at 4.1%. A historically low level. Real GDP growth stands at 3%, one of the most rapid rates of growth among developed economies. And in case you don't believe the government's data, the US stock market is hovering only a few percentage points below all-time highs, not exactly a sign that we're in a recession. So is it possible that the Federal Reserve has officially achieved a soft landing? This term, soft landing, is supposed to compare the Federal Reserve's interest rate to an airplane that, after having taken off and risen significantly, is able to come back down gently without causing any turbulence, something that history shows the Federal Reserve has rarely achieved. When we look at the Federal Reserve's interest rate going back to the 1970s and we add the National Bureau of Economic Research's official recession bars, we see that the vast majority of the time when the Federal Reserve raises interest rates, it ends up playing out for an economic downturn. There's really only been 3 soft landings going back to the 1960s, and today we may be seeing the 4th soft landing. 17 months, or around a year and a half is the amount of time that it takes for the Federal Reserve's actions to be fully felt by the economy, at least according to most academic research. This is why the financial crisis occurred 17 months after the end of the Federal Reserve's rate hikes. In fact, if we come back to the Federal Reserve's interest rate and simply overlay the unemployment rate on top, many of the times where the Federal Reserve has raised its interest rate, around a year and a half later, you see the US unemployment rate rise too. In fact, if we go one step further and shift forward the Federal Reserve's interest rate, we see that it matches the unemployment rate very closely. This is one of the charts that we've been pointing to throughout 2024 to highlight that recession risks were elevated over the last year. Here we are in 2025, and yes, the unemployment rate has risen as the US economy has cooled down substantially over the last year, but it has not risen to the point of triggering an economic downturn. Now, it's been 17 months since the last rate hike, and the Federal Reserve has even cut interest rates since then. We think this increases the odds that the unemployment rate is likely to flatten out and potentially even turn back down, which is of course not something that you typically see during a recession. But in order to have a complete picture, we can't just look at what the Federal Reserve is doing. While the US central bank does have an incredible amount of influence over the business cycle, ultimately people and businesses borrow from domestic banks, not the central bank. The central bank loans money to domestic banks that in turn loan out money to people and businesses. Just because the Federal Reserve has been loosening up its policies over the last year and a half doesn't mean that domestic banks are necessarily giving out easy loans to people and businesses. If that's the case, this can still lead to an economic downturn even though the Federal Reserve has stopped raising interest rates. And we can see what domestic banks are doing by looking at this chart right here. It shows us the number of domestic banks that are tightening their lending standards to businesses. In other words, when this line is rising, it means that domestic banks are lending out less money to people. When this line is very elevated, it suggests that credit is very tight, which is typically something that happens right at the start of a recession. The 2008 financial crisis is a great example of this. The Federal Reserve stopped raising interest rates in July of 2006, and over the course of the 17 months that followed, domestic banks continued to tighten their lending standards, eventually dragging the economy into a recession. Today, it does not look like domestic banks have been behaving in a similar way to pre-financial crisis. Since about the third quarter of 2023, domestic banks have begun to loosen their lending standards again. If we add the US unemployment rate on this chart as well, we see that tighter lending standards precede a rising unemployment rate. Again, if we shift forward these lending standards by a year and a half, it's a very close match. Yet again, that illustrates why we've been expecting the unemployment rate to rise throughout 2024. But here we are a year and a half after this peak, and it now seems more reasonable to expect a downwards trend in the unemployment rate again. So both the US central bank and US domestic banks over the last year and a half have been loosening up their lending standards. This is not something that precedes recession. So for the first time in over a year, we are changing our opinion on the likelihood of a recession. We do not expect a recession to occur in 2025, and this has absolutely massive implications. Throughout the entirety of 2024, we were calling for the stock market to move higher despite the risks of a recession. Now that the next recession is likely getting pushed out, that makes us even more confident in our call that this bull market in stocks can continue. After all, history shows us that the largest stock market drawdowns have been accompanied by economic recessions. The reason for this is simply that stock market earnings go down during these periods. If we look at a chart of S&P 500 earnings going back to the 1990s, we see that during the 2001, 2008, and 2020 recessions, earnings contracted significantly during these periods. Over the last couple of years, stock market earnings have been rising significantly as the economy has been able to sidestep a downturn. And if a recession isn't on the horizon in 2025, that could allow earnings to continue moving higher over the next year as the economy continues to grow, pushing the stock market higher as that happens. There is one big caveat to this, however. As recession risks are going down, the risk of inflation ramping back up in the US is becoming a reality once again. And we know that with higher inflation risks also comes the risk of higher interest rates. We've already seen a glimpse of that over the last couple of months as interest rates in the United States, like the 10-year government bond yield, have risen significantly recently. And to us, this rise in interest rates is most definitely responsible for the recent stock market volatility that we've been seeing. If US interest rates continue hovering around these high levels as the economy avoids a recession, it could lead to a more choppy bull market market than the one we've been used to in 2024. As a result, we are shifting our trading strategy at Bravos Research in a way that we think will make us come out on top this year. If you want to find out more and get access to all of our buy and sell alerts on the trades that we're making in real time, make sure to go.
So with that in mind, and I will tell you, we have a number of resources we use. Bravos is just one of them. They, as they pointed out a moment ago, have throughout the last year been pressing forward the idea that there could be a recession. They weren't the only one. We had many of the groups we were working with were talking about recession. If you remember the last few advisory reviews we've done, we've talked about how recession likelihood has been going down from groups like JP Morgan and Goldman Sachs, but still was there. I would also point out that while I hope they're exactly right that there is no recession in 2025, there are many things that happen that we don't expect. And so consequently, there are many geopolitical issues out there that could cause problems. So having said that, you start the beginning of a time period, in this case, 2025, and you say, this is what we think is going to happen. You build your models based on what you think is going to happen, but you always are prepared to make adjustments accordingly if new things happen. So for instance, if a problem with China and Taiwan were to develop, that could change a lot of things. If Israel and Palestine continued to decided to discontinue their ceasefire, that could be problematic. And the fact is, whether it's Russia and Ukraine or roughly the other 135 other conflict zones on the planet, all of these things can create many, many issues. I was just looking at an earnings calendar today, and looking at literally dozens and dozens, if not hundreds, of items that pop up every single week that identify changes in other countries' currency, interest rates, other central bank behaviors. So all these pieces come together and can create a lot of information. And that information can then cause problems out there, both in the economy and in the markets. So I shared with you just one resource we use because really the fact is I thought it was a great resource. It explained something that I could probably take in 10 or 15 minutes to explain. I thought it did it faster. But most importantly, I wanted you to see that when we're looking for data, we really are trying to pull together great resources to answer questions for how we build portfolios. I'm very pleased with our performance this last year in 2024. And for those that were aggressive growth investors, they saw performance that was around, if not above, in some cases, the S&P 500. For those who had a more conservative approach, maybe they were a 50-50, they saw their performance in similar areas. That's not going to be the case every single year, but we work hard to try to identify what opportunities are out there and then what are the best way to take advantage of those opportunities to get that return we're looking for, whether it's growth or income or both, to minimize taxes along the way where that's possible, to protect against loss and downturn if we have economic calamities that pop up. So these are all pieces that we do. And so by showing you some of these resources, I'm really encouraging you to recognize we're not just sitting here throwing darts at a wall, but we're actually trying to pull together information. And so I want to, in the spirit of that, take and go a little bit further in this discussion as well. If I were to take a look at, for instance, the S&P 500 and some of the tactical analytics for the S&P 500, one of the first things I point out is this didn't change hardly at all from November. We can see how we have the floor of support in both areas here. We can see how the market bounced into it. It's tested it a couple of times, taken off, and this three bounce attack here, where it bounced off the floor of support and then moved back up again, makes me really think there is a great opportunity. It could break through this ceiling of resistance, what was just described in that video a moment ago for the S&P 500. That could also include the NASDAQ, the Dow, the Russell 2000 as well. I would also point out that while it's doing this, it's simultaneously on the MACD, the short MACD moving average convergence divergence, it's moving up towards the zero line, which is another good sign whenever it's above this, how we see market growth that accommodates that strong moving average convergence divergence to the positive. I would also point that the on volume has continued to hold steady as it's making these adjustments in the market, as well as the relative strength indicator has broken above the 50 percentile, now also strong, and makes me think that what we just saw in that video really does bode well for some strong growth in the economy and the markets. Now, why am I saying this? Well, because for the last number of months, I've been encouraging people just to be careful, not to get too aggressive, because I was concerned about what could happen if we got too aggressive and the markets fell. We had a lot going on, the presidential elections, a lot of conflict around the world. And so we wanted to be more careful. At the same time, when you see opportunity, it'd be foolish not to take advantage of it. And we can tell that, for instance, with the S&P 500 on this chart here, this is the 200-day moving average. This is the blue is the 50 and the green is the 20. We can tell that the market performance is well above the 200-day moving average. And so if you have everything lined up properly with the markets, the economy, all the pieces together for economic growth, it bodes well that we should probably start looking at getting things invested more aggressively to match your risk tolerance. And I put that last piece in as an important caveat. This doesn't mean that we want to go out and just go to, risk all and take advantage of everything, because that's not the case. Some of you, and we're going to talk about this in a minute, some of you score higher on your risk behavior, meaning that you're more of a risk taker than a risk avoider. For those of you who are more risk taker, this might be the great opportunity to really start taking advantage of some of that. We've talked about the themes that we're using with AI and basic materials and infrastructural build to help support AI. We've been talking about that as great opportunities. Now those seem like they're even better opportunities if everything continues on like it is. So with that in mind, let's take a moment to kind of review just investor types for a moment. They're really more than 8, but I picked out 8 that sort of express who we are. And so we've got active investors, passive investors, growth investors, and value investors. The active investors actively manage their investment accounts. And we have some clients that, while they let us handle a big portion, there's a piece they like to handle. They want to do that. They're actively managing. They have high involvement in stocks, picking and technical analysis and so on. And their risk tolerance is typically higher, and they're more into active trading that can lead to higher volatility, but they're okay with it because they're risk takers. While I don't think we have any day traders or swing traders in our clientele, those people tend to be somebody who are more open to trading. The passive investors, they take more of a long-term approach by investing in index funds, ETFs, or other portfolios that are diversified. They have minimal trading. They are aiming for market average returns over time. Their risk tolerance is moderate to low, and they focus on steady growth. And they typically would be that buy and hold investor. Growth investors are also people that are focused on investing in companies. They could be both passive or active. It's not a requirement in that sense. They're looking for sectors with high growth potential, often in emerging markets or technologies. Their focus is on capital appreciation rather than income. Their risk tolerance is high, as growth stocks can be volatile. And examples would be they're investors in tech startups or innovative industries. And even quite honestly, this last year, I've had a number of people who I didn't think of as growth investors who have been clamoring for more AI opportunity, artificial intelligence opportunities. Value investors, they seek undervalued stocks or assets. They believe that trading below the intrinsic value, they're the people that believe that it's buying it at the right price that makes it all work. Their focus is long-term capital appreciation, and they often like dividends. Risk tolerance is moderate, relying on thorough research to mitigate risks. And some examples might be Warren Buffett or several different value investor philosophies that we could pull on. I would tell you that a lot of our clients probably do fit in this category. We certainly have active, passive growth investors, but it seems like most clients, especially as they're older, are more interested in maintaining what they have and growing it steadily with stability. That's the first 4. The second 4 are income investors. Then you got speculative investors, defensive investors, and then those who have a desire for impact or socially responsible investing. On the income investors, they prioritize generating regular income from their investments, like dividends, interest, or rental income. They seek steady cash flow rather than capital appreciation, although because of the rising cost of living and the inflation we've seen in the last few years, they have become a little more interested in capital appreciation to make sure we stay ahead of the rising cost of living. Their risk tolerance typically tends to be low to moderate, and they favor more stable assets. They're retirees investing in things like dividend stocks, REITs, or bonds. Speculative investors, they take significant risk. You can imagine they're going to be the high risk takers. They seek active, potentially high rewards, and they're often in volatile or uncertain markets, and they're fine with that. They're high reward, high risk investors, opportunities. They look at things like cryptocurrency, IPOs, and penny stocks. I will say that crypto and penny stocks are not things that we can do. So we have some clients who will do those things outside of us. Brokerage platforms don't allow for crypto yet, even though there's a few funds out now that ETFs that allow for that. And there's a couple of companies that will let you buy crypto inside them, but it is not the typical brokerage kind of accounts. And penny stocks, they're very specialized as well. IPOs, you've got to have some plan ahead to take advantage of those. They come along, but you've got to have a real serious appetite to find those initial public offerings to make that an opportunity for you. They usually have a very high risk tolerance with a willingness to accept potential losses. You may remember in a previous discussion, I talked about the sort of two types of investors, those who get excited those who would be very animated if they found $100, and those who would be very animated if they lost $100. And these people on the speculative side, they are very animated when they find $100. They don't get very animated if they lose $100. So if you're not that person, this isn't your group. Again, examples for that would be cryptocurrency traders and venture capitalism. Defensive investors, the third column over, they prioritize preserving capital and minimizing loss over achieving higher returns. They're typically lower volatility investments like bonds, blue chip stocks, or money market funds. Their risk tolerance is very low, and they aim for stability and security. They're conservative investors seeking to protect wealth. And then finally, the last group, which is an interesting group, we have, I would say, a handful of clients who really this is an important piece for them, but they are socially or maybe faith-based responsible investors. They invest in companies or projects that align with their ethical, social, or environmental values. They balance financial returns with positive social or environmental impact. They vary depending on the investment choices as far as how their risk tolerance goes. They can be high risk or low risk or somewhere in the middle. And some examples of that would be people that invest in, say, renewable energies or faith-based investing. And so all of these types, all 8 of these types, we can help people to invest in. We're able to work with them through this process to build portfolios that match those goals and desires. So the question for you to kind of think about is, which type are you? Are you type of the investor that you align with having goals that are looking for more for growth or income or capital preservation? Is your risk tolerance? Are you more into volatility and you can handle loss, or you just really can't take it? And your involvement, do you prefer more active or more passive management in your investment strategies? Understanding that helps us as your advisors put together a good model for your portfolio and your family's wealth management. So with that in mind, I wanted to spend a little bit of time talking about how our process works. I've shared various pieces with you in the past, but I'm going to drill down a little deeper tonight to make sure that you understand how we come to do some of the things that we do. You've seen this before. We talk about how your family wealth is divided into these 8 different circles: cash reserve, we'll call them buckets instead of circles, cash reserve, bonds, equities or stocks, real estate, tangible assets, currency, business interest, and in some cases, insurance and annuities, which may model the other 7, but they have certain protections or stabilities built into them. But when we take a look at how we do what we do, I'm going to share with you some of the things that we do. So when we put together our blueprint allocation for clients, and we just had our monthly investment review meeting with staff today, where we talked about the blueprint allocation for a number of new clients that have come in, as well as some existing ones that we're making changes on. And so what I'm going to do, instead of showing you this slide, which is nice, but I'm going to actually take you and show you how we do what we do through some of the resources that we have. So there's actually 3 slides I was going to show you. I'm just going to kind of jump around and do this the way I want to, and we'll go back through it. So you might say, and people will say to me, well, Frank, how do you track all of this? How could anybody track all of this? Well, first things first, we use a resource with stock charts that helps us put together thumbnails of all of the charts. We can choose to rank them based on anything we're looking for. We can choose to look at them for relative strength indicator, MACD, money flow, on balance volume, any number of ways we can look at. We can choose to do it for the last 6 months, the last year. We can do it during any number of ways we want to look to say, well, what would we look at right now? And so this is set up in descending order. So the top one here, this particular security, we say, well, okay, that's really high on the chart. We like what it's saying. Is it the right time to invest now? And I want to take a moment here, because the fact is is that when I presented this to the broker dealer to have them give me approval to be able to share this with you, their big concern was that I might be trying to advertise performance. I'm not. There are good charts on here and there are bad charts on here. There are securities that we own and there are securities that we do not own at this. This is our way of staying on top of some of the things that we're looking for. We have equity positions we track. We have ETF or exchange traded fund positions we track. We have mutual fund positions we track, trying to constantly determine what's the right place to invest based on the current economic and market situation. I cannot impress upon you enough, there is no perfect investment. If there was a perfect investment, then somebody like Fidelity or Vanguard or somebody, one of the top names that everybody knows, they would have already created it. They'd have one mutual fund, and that one mutual fund or that one exchange traded fund would do everything. But they don't, because they can't, because the roadmap is constantly changing. I mean, sometimes it's good to have a sports car. Sometimes it's good to have a pickup truck. Sometimes it's good to have a moving van. It depends on what you're trying to do. There is no one size fits all. And so when we look at a bunch of thumbnail charts like this is really just taking a time to look on a regular basis to say, hey, what do we think is happening right now? And on times when things are catastrophic or changing dynamically, then this is a good way to see some other opportunities. And not only do we have this for these various securities I just mentioned, but we have it for market indexes. We have it for the 11 industries. So we can go through and say which industries are performing best. So we can then begin looking at securities in those industries to begin building out portfolios and making adjustments. Now, you might say, why are we talking about this tonight? Well, because I think we're at a point where there's some big changes happening. And I want our clients to be in on the early part of that. And so in our managed accounts, we're starting to make changes based upon our clients' goals with growth, income, flexibility, tax management, risk tolerance. And so we're beginning to look at some various options that we wouldn't have looked at last year because we just didn't think they fit well. And so this is part of how we make some of the decisions that we do when it comes to choosing investment opportunities. Another site that we use is Seeking Alpha. It's been a great resource for us. It shows us lots of information. I've got this particular chart set up, and again, I'm not suggesting any of this is something that you should do, and I'll show you why I'm not suggesting it. I'll get a little bit down the road here, because it doesn't, whether you are sitting here tonight or you're watching this 3 months from now, everything will be changing and your situation is changing. Some of you need income, some of you need growth, some of you are risk takers, some of you are risk avoiders. There's no great perfect answer here. So please don't walk away from this and go, that's what I should invest in, because the truth is we're trying to put together a balanced portfolio with the various circles you saw a moment ago to help you make the most of what you need and accomplish your goals. But I set this particular chart up to just measure the Seeking Alpha analyst ratings on these various securities. And you'll notice all of these are green down to about here. And so that's the first thing I would say is, well, and when we're doing regular equities, they will have Wall Street ratings over here. They have their own measurement called the quant rating, which we could talk about. But what I'm saying to you is that we're looking for various things that we think make sense for helping clients achieve growth and income, risk protection or volatility avoidance or minimizing, to help people put together these various things. So I've picked out 2 securities that I'm going to show you tonight, and I am not showing you these as a recommendation for you to do it. I can tell you these are 2 securities we don't have in many of the portfolios yet, but we're looking very seriously at putting in. If what you see this, you want to talk with me afterwards, please feel free to give me a call. We'll talk about the pros and cons of these, whether or not they fit for you or not. But I will tell you that these are 2 that I've been tracking for a while. I think they have some very interesting opportunities to them. Now, having said that, I love growth. I really do. I love it that NVIDIA or MicroStrategy or McDonald's. I love when companies go up in value, but the problem is I can't count on that. And fortunately or unfortunately, most of our clients, they need consistency with income and access. And so consequently, we try to, every chance we get, take advantage of those growth opportunities. But if I can get nice income, if I can get income in 5 to 10 or maybe a little bit more percent, that means a lot. Because while it's great to capture a 12 or 15% or higher growth in an S&P 500 or a security that does that, it's terrible to see it go down 10 or 15%. it's terrible to see that portfolio drop that way. And so if I can set up clients with income with growth attached to it, now that's what we're looking for here. And that's another thing that we're using these sites for. So I'm going to pick out one that kind of we're sort of I'm very impressed with, called SPYI. Now, before I tell you anything about it, let me just share with you a couple of things. For those of you who have done your nitrogen risk score, or formerly Riskalyze score, you know the scoring is from 1 to 100. This particular security is at 55, means it's more risky by a bit than 54 other funds or 54 other types of securities that could be in this chart. So it's a little higher risk. It's not terrible. It's very much in the middle, but it also at the same time is producing a dividend of 9.85%. And so when we look at the dividend of 9.85% and we have a risk tolerance somewhere in the middle there, that gives me a lot of confidence that that has an opportunity for our clients. It also has a very decent expense ratio, 0.68, 68 basis points out of 100. So it's a relatively inexpensive fund compared to, say, mutual funds. It is more expensive than the average exchange traded fund, which is typically around 35, 25, 45, somewhere in there. But for the income that comes off of it and the ability for it to perform, which I'll show you in a minute, that's not a bad deal. That makes me feel pretty happy that we can do such a thing. And again, now, this is not the perfect investment. It's not going to be the one that you choose. You'll never have to buy another fund. It will have its down days and difficult times as well. But if it can continue to produce that around 10% income, and it can continue to hold its value, not lose its value along the way, and maybe even eke up a little bit, that's one of the things that I have found very interesting. So when I look at that, SPYI, I'm looking at for the last year, and you can see it continued to eke up over the time while it was paying that dividend. Do I look at the right one here? SPY? Yep, SPY. So that's interesting. It says 9.85 on nitrogen, but Seeking Alpha says it's 11.8% dividend. So 11.8% dividend, plus it's continued to climb over this period of time. Even when the market has tanked a bit, it's still continued to hold its own very nicely. So it gives me confidence that this is one of those types of funds that we could look at for clients to generate dividend, especially if you take that dividend and you reinvest it back in the shares. So when you're buying back into the share price, if you don't need the income, we can just let it reinvest for a while and pull your income from other places. When it goes down, we get to buy it at a discount. When it goes up, we buy less shares. When it goes down, we buy more shares. So it makes it so we can create almost a dollar cost averaging over a period of time with it. And as I said before, its expense ratio is still at 68. It's just that the dividend reporting here, the yield on it is about 11.8, which is higher than what nitrogen was showing. This is why we look at various sources like stock charts, Seeking Alpha, nitrogen, plus a few others that help us decide what we want to do with this. So this is one example of a fund. Now, how does it generate this income? I was going to tell you that, and I got sidetracked. The way it generates income is it is looking with high income S&P 500 companies, but it also sells covered shorts or covered puts or calls to generate income. So it has the ability to generate a nice income as those covered calls come out. Its dividends or covered puts, or I'm saying options, but I should say covered puts or calls. And while it's doing that, it's generating the revenue from both dividends and from that growth piece that generates the income out. So with that in mind, it helps clients to have a nice income. I believe the income on this one pays quarterly. I apologize, I didn't check that up ahead of time, but I think it's a quarterly dividend. And so that consequently gives our clients a nice growth opportunity. You know, I'm thinking it's monthly, actually. I'm sorry, I have to check that. Oh, wait, you know what? I think I can tell here, dividend history. Nope, doesn't tell me. I'm pretty sure. Oh, no, it is. It's quarterly. I was right the first time. It is quarterly. So the point is by having that income distribution, it makes it so our clients can have nice growth. They can have a fund that maintains its value, and then we can reinvest for those who don't need the income out directly. And it's a decent income level in today's economic environment. Let me share with you another one. And again, this is not one that I'm saying, oh, this is what you need to run and do. Let's also take a look at what nitrogen has to say about it. This is from JP Morgan. Again, it's another, but instead of doing the S&P 500, this one does the NASDAQ. Its dividend is 9.51. Let's just make sure that Seeking Alpha says the same. It says 9.5 on the forward for this one. You can tell by the chart. It's also had a very nice chart looking back over the last year. I believe dividends are. I thought the dividends on this one are monthly. Oh, here's history. Are monthly, but let me confirm that. Oh, nope, they're going quarterly dividends as well. So we got quarterly dividends, a very nice payout rate, a fund that has held its own quite nicely in a market environment like we went through the volatility of last year. It seemed to do a very good job with that volatility. I jumped past it. Its risk score is 70. So that makes it's still in that third quadrant. So 75 and up will be the fourth quadrant. 50 to 75 is going to be the third quadrant. Below 50 to 25, you get the deal. So it's still, it's more risk than the previous fund, and it's paying a lower dividend. But the fact is, it's a very nice dividend, and it's held its own. And JP Morgan has done a great job with this fund as well, not only for dividends from the internal securities, but also for the covered puts and calls that it operates with when it sells those. So these are two examples of programs we look at to try to maximize clients' portfolios, to give them growth and income, whether that growth is from appreciation of share price or dividend reinvestment. And it makes it so clients can see, have a level of safety and stability in the portfolio at the same time. Now, with all these pieces I'm showing you, again, I want to, again, qualify, this is not saying this is what you should do. This is a very, and the reason I've hit the disclosure discussion a little bit heavier tonight is this is a very individual decision. Each person needs to make sure that as they review everything, it makes sense to them and they're ready to go with that. And so this is a conversation that you should talk in more detail with me. We'll get you information if you want to. But if it matches your risk tolerance and it meets your investment goals, these are the types of things that we're looking at to add to our clients' portfolios. Let me go back to our presentation. So as I was saying before, this is just designed to help you understand how we do our blueprint allocation, how we manage for strategic growth and tactical income, and how we try to help people accomplish their goals. Whether we're doing this using the Seeking Alpha or stock charts or nitrogen or one of the other half dozen things that we put together, this is our way of staying on top of it and then making investment choices. Because truthfully, it's a joke that I made for, I don't know, the last couple of decades, but it is not really a joke. It's true. Investors only have a hard time with their stock portfolios or their wealth portfolios at two times. One, when they're making money, and two, when they're losing money. When they're making money, we suggest it's time to pull out, get rid of some of these things, and maybe sell out and take your gains. They don't want to because they're afraid they're going to miss something. And when they're losing money, it's even harder because they're afraid if we say, well, let's go ahead and sell out because there's other things that are working, they won't sell because they don't want to lose. The reality is that we have very specific guidelines we're working off of, very particular measurements that help us decide that even if I struggle with the same fear of I don't want to miss out or I don't want to lose, I'd much rather look at the next opportunity and take advantage of it. And that's what a professional is supposed to do. And so that's why we use some of these resources. And there's much, much more I could spend on this, but in the purpose of time tonight, I'm going to have to call it quits on some of this discussion and remind you that what we're really talking about here is the three types of analytics that we do when it comes to our portfolio management. Fundamental analytics, which is determining which types of investments, whether that's stocks or exchange-traded funds or mutual funds, really represent the kind of programs that we want to invest clients' money in. We want to choose things that we have confidence are going to be there when the client needs it. Technical analytics isn't about choosing the right companies. We've already done that with fundamental. Technical analytics is deciding, do we buy or sell now? Because we could find a great company, but it's not the time to buy it. There are many great companies and many great funds, but now would not be the time to buy it because of maybe the way the market, maybe the way interest rates are operating, maybe the way the Fed is operating. There could be a number of reasons why you wouldn't buy at this time. But if you have companies you like and trust, and then you decide this is the right time to buy or sell, that makes it much easier. And then finally, behavioral analytics. I wish the market was just as simple as facts and figures and accountants would be the wealthiest people on the planet because they count numbers and everything would make sense and we'd have to do that. But the reality is life doesn't work that way. There's behavioral processes. We're going to see that My guess is that while the numbers I'm telling you are all accurate, the fact is there's probably going to be a lot of discussion from the media how the economy is getting weaker and how there's serious problems out there now and how we have to be careful because there's always a lot of noise about people's feelings and behaviors and what's going on. And so we have to take a look at the fundamentals of who would want to buy or own or invest in, the technicals of when we want to do that, and the behavioral processes that may be affecting how the technical and the fundamentals are working. So with those pieces in mind, we're constantly trying to put together the right portfolio for clients. As I mentioned before, I'm pleased with how 2024 went. For clients who were really aggressive, we did a great job around the S&P 500 performance numbers. For clients that are less aggressive, I feel like we still did a great job. My big test always is when things go south, how do we help people through that? How do we minimize that downturn? Because if the S&P 500 goes down 25%, I don't have a single client. None of you will be excited if I say, oh, it went down 25% like the markets. You're expecting us to make decisions to help minimize that. And while it's impossible, it's just impossible for anybody to guarantee you won't lose during those times. It is very possible to try to minimize that loss, to try to set up programs, investments, strategies to minimize that. So if it goes down 25%, but you only go down 10, while nobody's happy about that, it's easier to climb out of a 10% hole than it is to climb out of a 25% hole. And so that's why we do all this work to try to stay on top of it for you and for what we do with our firm. So in kind of closing out for tonight, I can see the time I'm running out here. I just want to remind you a few things that we're doing that may be helpful to you. It's not just about investing and all of that. That certainly is a huge piece of what we want to do for clients and to help you meet the goals you have: growth, income, flexibility, tax management, liquidity. It's our goal to help put together portfolios to do that. But more importantly, it's our goal to help you have the return on life, not just return on investment or return on equity, but also the return on life you want. And so that's why we do the planning software that we do. As I've reminded you many, many times, there's the 3 phases to yours and my financial journey. There's the pre-retirement or accumulation phase. You get to the top of the mountain, you plant the flag. There's the post-retirement decumulation phase, understanding how sequence of return risk can impact you, understanding how end-of-life risk can impact you, achieving your desired return on life, and then finally taking what's left and transferring it to your loved ones and the people you care about, an effective way to accomplish the goals you have and the goals they have. Everybody is working through the same process, and we put together planning processes to do this. We have dubbed the financial planning process, as you can tell here by this is what your financial dashboard looks like. We call it the Your iExcel financial dashboard, because all of the pieces we put together are designed to help you excel where you want to go to achieve your goals, whether it's to meet goals this year, meet goals 5 years from now, meet goals somewhere in the distant future, where our goal is to help you do that. And using these software resources that we do include things like your eMoney financial dashboard, your Albridge portfolio dashboard, your nitrogen risk and reward evaluation, your financial life plan, looking at your life goals and life transitions, and then the tax software, the investment software, all the other pieces behind this that make all of this work well. Our goal is to make it so you're excelling to accomplish what you want to achieve. And that's why we put all this together for you. So this is that place where I'm going to say, if you have questions, go ahead and either ask your question or raise your hand. I'll do what I can to help answer those. But just because I know that some of you are thinking right now, you want to get some things together, let me just remind you that our next investor advisory review will be February 18th, where we're going to take time to build on this. I'm probably going to drill down a little deeper on some of these other pieces so I can spend a little more time trying to give you sort of a 10,000 foot view. Maybe we can get to 5,000 foot view in our next review. So the things we covered tonight, the 2025 economic outlook, hopefully you have some confidence or some new thoughts about how that looks, likelihood of a US recession in 2025, potential investment opportunities, the market tactical analytics, the Frank Reynolds and Company difference for portfolio management, as well as achieving the financial planning goals you have. And then I'm going to take a moment for questions and such. So also, if you would like to invite your friends to this, you are welcome to do so. Let Megan know at megan@franksoffice.com, because she'll make sure that they get an invite so they can join us as well. We've hired a new video editor, And so I believe we're going to start having these updated on a regular basis. So hopefully within a week or two, this will actually be on the website. And from this point forward, our goal is to make sure they're always there to help you identify what's going on. Go back and watch some of this if you have questions. So now let me see if we have any questions. So no chats. I don't see any raised hands. So apparently I have done a great job of helping you understand what we're doing. So it is now 6:20. I'm ready to go have some dinner with the lovely and gracious Jane. I'm going to just slow walk this for a second to see if there's any questions that pop up. But assuming there's not, I will look forward to talking to you all soon, whether it's on February 18th or it's in between now and then. If you have any questions on anything I've talked about tonight, or you just want more information on any things that you've seen, I'm more than happy to help you understand it and get that for your own benefit. So with that in mind, I still don't see any questions. So I'm going to go ahead and bid you adieu. Have a wonderful night and a wonderful week. God bless. And I definitely look forward to talking to you soon. Thank you. Have a wonderful day, wonderful evening, and a great week.